Well, hello and welcome. Welcome to our quarterly market update for the third quarter of the year 2022. I'm hosting it, and my name is Peter Watson. There's going to be three themes that we're going to be concentrating on today. First of all, the theme of volatility, and the second, the theme of volatility of human emotions. Because when the stock market goes up and down in wild swings, as has been experienced in the last quarter, the last year, that takes a toll on the human emotions of investors. And finally, because of the extra volatility this year, we want to use this quarter and this year as a learning experience. What does this teach us about the future for investing? Well, we're going to start off by looking at the quarterly results for a number of different asset classes. And there's only two asset classes that we want to focus on. First of all, the US market. In the last quarter, the US market, and that's the second column from the left, the US market has gone up. But because most of the arrows are pointing down, let's go right to the bad news. The worst quarter that we've had for these five first categories, the five categories that we're going to talk about, start off, the worst quarter for the Canadian market was 2008. I'm going to skip into the third column. The worst quarter for international markets was 2008. And then the next column, 2008, and the next column, 2008. Sometimes markets just don't behave very well at all. Now, there is an expression in finance, regression to the mean. And what does that mean? Well, say your hockey team over a season is going to win 60% of their games. That's how good they are. They're not that bad. They're not that good. They're going to win 60% of their games. So if they go on a 15, 20 game sort of streak where they're winning 80% of the games, generally what happens is things over time average out. So they might start losing more games because they are about a 60% gain. Well, the same thing happens with the stock market. If you have a significant loss, quite often there's a rebound. And so in the going back down, looking at the worst quarter on the bottom left, if you come up just a little bit, you'll see the best quarter was 2009, the next year. Now, skipping over to the third column, you see that, again, 2008 was the worst quarter, but 2009 was the best, good, strong rebound. And then finally skip over two more, 2008 worst, 2009 the best. But look at the second column. The best quarter was 2020. Now, that's like the hockey team. All of a sudden, you won 10 games in a row. You're not going to win the next 10 games in a row. 2 years later, you had your worst quarter. Now, because there tends to be this regression to the mean, if you were to look at, and we're not showing it this time, but if we were to look at how the stock markets have performed over the last 100 years, it looks fairly smooth from the perspective of 100 years. But if you look at that sort of quarter by quarter or year by year, there is a fair amount of ups and downs back and forth. So that's a real concern for investing and how we emotionally react to investment swings in the market. Now we're going to go over, take a little longer term approach than just the quarter. We're looking at numbers here for 1 year, 5 years, and 10 years. We're only going to focus on the second and third column. The second column is US. The US market last year, it went down 10%. But if you look at the last 5 years, including last year being down 10%, over the last 5 years, on average for each of those 5 years, you've been up 10%. Over the last 10 years, you've been up 15%. Now, the international market had a worse year this year at 18% down. The next column, perfect, thank you. 18% negative. But on a 5-year basis, it was at least in positive territory. Not bad given an 18% return. Over a 10-year period, they had a fairly respectable 7% return. So that's how the markets have worked. We've avoided Canada for now, and we'll get to the reason for that in a second. It's had similar downs and ups, but we'll get to that in a second. This next slide provides a very strong perspective of the stock market over the last 12 months. And there's two things here. One is the investment return, and the other is the sort of the emotional wear and tear that investors might be going through. As you can see, starting on the left, the market basically throughout most of the year was up and down, but mostly trending downwards. And then at the beginning of the summer, towards the right-hand side, all of a sudden the market turned around and went on a bit of a summer rally that got everybody pretty happy and excited. But then come first of August, it started going down. So it's been a typical year, been up and down, and more downs than we are usually accustomed to. Now the fine print at the bottom, we've left the fine print in because if you want to sort of look at these slides in more depth on your own, you can look at that. But for now, I'll just go through and explain what's happened. We're looking basically in the small print. We're looking at the headlines that have occurred over the last 12 months. These are the things that we all hear about and read about. Well, first of all, and what we're looking at is the potential human emotion of the roller coaster of ups and downs and different types of news. Well, the first one talks about the NASDAQ drops 2% as investors flee shares. So there's a lot of angst in that one. But then we go on in a wild year for stock markets, pull off big gains. Then all of a sudden the S&P 500 falls into a correction. By this point, you're probably getting a little bit whiplash. Then gas prices are shooting up, fastest on records. Strong dollar extends the gain, and there's no end to the rally in sight. And then stocks extend a losing streak for 5 weeks. And then finally, the UK inflation, basically, and the US inflation, they're at 9%, 10% respectively. That's not good for investing. And then in the United States and in England, they're raising the interest rates, which is going to push us into a recession. So basically what you've got is, on the top part of the slide, you've got volatility for your investments. And then you've got, in the bottom part of the slide, you've got volatility for just your emotions. Going on and looking at the next few slides, this one, and all we want to focus on, there's lots of information if you want to look at it on your own. The main thing we want to look at is the bottom left 3%. That little wedgie in the globe represents Canada. If you're looking at all the stocks that you can buy in the world, all publicly stocks that you can buy in the world, 3% of those stocks are in Canada. So if you have an overweighting of your position in Canada, you're not following good diversification. Diversification is your friend. You don't know what the market's going to do. So you want to spread your risk over as many categories as possible. The reason why we skipped over the Canadian on the initial chart was because it's such a small part of the world portfolio, and consequently, we recommend for our clients that it be a very small part of your portfolio. Now, moving on to the US. The US, as you can see, bottom left, 61% of the world publicly traded stocks are located in the United States. So you want to have a big position in those types of companies. Now that is a little bit misleading, and the reason for that is that a lot of US companies, sort of Google, Microsoft, those types of companies, yes, they are head officed in the United States, and so they are, quote, a US firm, but they really operate throughout the world. And so when you're investing in those US stocks, you're really investing in commerce throughout the world. So there's very strong diversification. Now, in terms of then looking at international stocks, that accounts for 24%. Now, by international, we mean not North America, so no Canada, no United States, and no emerging markets. So basically everything in between Europe, etc. They're 24%. So we want to have a good position, not as high as the States, but a good position in international companies. And then finally, looking at emerging markets, and that's getting to be a larger segment, but it's now up to 11%. So you will have some participation in those markets as well. The next slide I find very interesting because it's really, what happened in the last quarter around the world. We've got 46 countries that we're looking at, and we're looking at the stock market indices to see how each stock market, each world country stock market performed. And you can see some went up and some went down. Now, the lines we've got, the middle line is representing of what the global portfolio would look like. So you're going to have some countries that are winners and some countries that haven't done so well. So you're going to have sort of a mix, an average of the overall returns. On the right, we see the red one. There's Canada. Canada was just slightly a little bit below average, and the US on the left, a little bit above average. Well, then the question here is, well, why don't we just, a year ago, come to our clients and say, why don't we invest all in this one country that's going to be the very best? Well, in the last quarter, the best country on the globe was Turkey. Now, there's no way from a risk perspective, we're going to suggest that you put all your eggs in a turkey basket because we think that's going to be the best hot country for the stock market. We've got no clue up front how the markets are going to perform. Diversification, again, that's the theme with us. Diversification is your friend. You want to spread your assets out. You're happy to get stock returns, and they over time will have a good return and have historically. We'll show you more about that in a bit. All right, so we've mostly focused on stocks. And why do we have fixed income in our portfolio? Well, the reason for that is quite simple. Fixed income acts as your ballast. So particularly in a time when the market's volatile, meaning it's going down, you want to have something that prevents your portfolio from going down to that same extent. Now, this has been a very bad period for fixed income as well as bonds, as well as stocks. At the bottom, you'll see we've got 6 different asset classes for fixed income. And look at the quarterly returns, the year-to-date, the 1-year returns, and the 3-year returns. So those numbers mostly are red. They're mostly declining. So yes, we've got bonds and other fixed income vehicles in as a ballast, but they reacted very poorly as well. Now, the returns after 3 years, the average annual return after 3 years is down 2%, close to break even, just 1%, 3%. So it certainly hasn't gone down as much as stocks. So in that sense, it was a ballast, but nonetheless, it wasn't as strong as we usually have it. In a positive, going forward, you can see the 5-year, 10-year numbers. They're fairly slight, but they're positive. You don't invest in fixed income for strong positive returns. And we'll get more to that comment on the next slide. And this next slide, that's absolutely my favorite. If there was just one slide we were going to have conversations with clients about investing, this would be it. This looks at the last 3 decades. If you had taken $10,000 back in 1994 and invested that $10,000 just in bonds, so global bond indexes around the world, that $10,000 would have grown to $36,000 as of the end of 2021. If, however, you had taken that same $10,000 and invested in 100% global stocks, now you'd be up to, for that $10,000, you'd be up to $139,000. So you can see that stocks, if you're looking for a high return, they do have a higher return historically. They do have a higher return expected going forward. That's what we would expect. If we were to look at the same kind of graph over the last 100 years, you'd have the same kind of things. But look at what happens from time to time in the middle of the chart and then more towards the right when you have volatility. The stock market crashes a fair amount. The bonds, they don't crash so much. They're really slow and steady. So this goes, and I think we'll leave this slide now. What this teaches us is if we're going to invest, we have to understand that stocks have a higher expected return and they have a higher expected volatility. Bonds, they have a lower expected return and a lower expected volatility. So investing starts, and I mentioned at the beginning, what can we learn from the extreme volatility that we've had in the last year, the last quarter? Well, what we can learn is investing starts with not your investments. It starts with you. What is your circumstances? What is your financial strength? What is your time frame? What is your aversion to risk? What is your ability to take on risk? That's what we want to look at. And then based on you and what your objectives, what do you want to achieve for educating your children to have money available for that, to having enough of a nest egg to enter retirement, to have enough of a nest egg to have that retirement money last for the rest of your life. What you want to do is quantify, say, okay, this is how much I need for those things. And then what we do is we build a portfolio that works around that, mixing for virtually all our clients. There's a mix, some stocks, some bonds. Again, repeating, we know bonds have a lower expected return, so they're a safer investment because less volatility, and the stocks are more a longer term. So that's basically how it goes. Now, like any business, what's our quality control for our clients? The quality control is every year we offer, and most clients take us up on this, to redo your cash flow numbers. So if you've got on your horizon educating your children, getting ready for retirement, having your cash flow last throughout your hopefully long retirement, we redo those numbers every year. And it's really the pictures on the computer screen, so you don't even have to look at the numbers. You just see that if things are kind of going upwards, that's good. If there are any adjustments that need to be made, maybe there's 3 years of bad markets in a row. I don't think that's happened in the last 100 years, but certainly there have been times where the market's been down 2 years in a row. We can make adjustments as we go. So when we look at the markets going up or down, yes, that's what the market's doing, but ultimately we want to look at the quality control tool. We want to look at the cash flow for you and your circumstances going forward. If you have any questions with respect to information we've covered on this webinar, please contact your wealth manager or speak to me directly. If you are not a client of the firm and you would like to have that discussion with us, please contact my daughter, Jennifer, and she'd be happy to speak to you about your needs and to see if we're a fit. Well, thank you very much for tuning into this quarter's webinar. This now takes us to the next webinar, which will be in late January of 2023. Thanks for tuning in. All my best in your investing. Goodbye.